Breaking news as real GDP comes in negative, drastically missing the market's expectations and signaling we are already in recession. And that's not all the market got wrong today, as ADP comes out with only 62,000 private jobs added, greatly missing expectations as well. PCE also comes out slightly hot, which is over expectations at 2.3%, possibly signaling stagflation. And the market, you guys, the market continues to be recklessly optimistic at the expense of your pension plan. But what if I told you the market meltdowns we're facing isn't as much about tariffs like the media wants you to think, as it is about the derivatives market and the unwinding of the basis trade, which is creating a liquidity volatility spiral, the likes of which you have never seen before. And not only are you going to learn about what the basis trade is and how it can potentially, guys, just potentially create a new type of currency, but we're also going to end this video talking about developers in the Florida housing market stampeding to the exits. We got a full-fledged housing market crash in the works in Florida, and we're going to talk about that and the reasons why. But first, happy Wednesday and welcome back to Real Estate Mindset. You guys already know this video is going to be absolutely bonkers. Mitch Vexler, how are you, sir?
Well, it's been a fairly miserable day here. The weather was bad this morning. We took a bit of a lightning strike. I got a server that's screaming with the fans. But other than that, the market's doing what the market's doing, so it's okay.
You're getting struck by lightning over there, huh? That sounds interesting. Jeez. All right, guys, let's jump right into how the market ended, and then I'll give you guys a full update, possibly in recession already. The Dow ends up 0.35%. S&P closing up 0.15%. The NASDAQ almost ending positive, but they gained a lot of ground. I mean, it's opened up in the gutter. According to the VIX, no volatility today whatsoever, as the VIX is only up 2.48%. GDP shrinks for the first time in 3 years as Trump tariffs, all about Trump tariffs, trigger record trade deficit, tip of the iceberg. From the Bureau of Economic Analysis, a new release just coming out, and I'll read this for you guys. GDP decreased at an annual rate of 0.3% for the first quarter of 2025, according to the advanced estimate released by the U.S. Bureau of Economic Analysis, and you can see that right there. That is a massive implosion of GDP. The decrease in real GDP in the first quarter primarily reflected an increase in imports, which are a subtraction in the calculation of GDP, not an increase. These movements were partially offset by an increase of investments, consumer spending, and also exports. You guys can see the categories right here. So government spending, very interesting, that's down slightly, but the imports, again, which is a negative to GDP, that surge. Private payroll growth slowed to 62,000 in April, and that is well below expectations. And those expectations, you guys, were 120,000, so coming in drastically lower. Here's the ADP National Employment Report right here. You see 62,000 jobs, but what I want to show you is where are those jobs? Let's scroll down here. Natural resources and mining, 6,000 for all that gold and silver, am I right? Construction, that's weird, 16,000 jobs added. Manufacturing, 4,000. Trade, transportation, and utilities up 21, but look at information, that's down 8,000, while financial activities is up 20, professional business services down 2,000, and this is the big one right here. The overwhelming, highly levered bond debt, education, and health services is down a whopping 23,000, while leisure and hospitality is up 27,000. Interesting, other services down 1,000. The March PCE report, PCE inflation index up 2.3%, and that is stronger than expected. Now, question number one for the viewers is this, okay? If you're a viewer, question one, what are you investing in right now? And I hope to hear you guys say in the relationships you love in your life, your children, yourself. But tell me, question one, what are you investing in right now? And Mitch, my first question for you, sir, is how far back do you think they're going to go into Biden's data and say, hey, we've actually started recession blank? How far back do you think they're going to go to say we started recession?
If the historians were truthful, right to the beginning of the Biden administration, because all the evidence shows that the reports that have come out whether it's the PCE or the GDP, it doesn't really matter. The books were cooked. And that's part of the ramifications, not just of Biden, but in reality, history of the Federal Reserve cooking the books on a mass scale. And that's part of the problem. So this will be a job for historians more than it will be for those that are creating the reports, because those that are creating the reports have a history of not being truthful.
Well said, Mitch. Now, a little bit of education. Like I said, this is a lot more about the derivatives market. And let's specifically talk about the basis trade, starting with an article from Zero Hedge that's really going to break this down for you guys. Titled, Unwinding the Trade, How Hedge Funds Trigger the Treasury Route. Now, a few things here, guys, and I'm going to make my way through this as quickly as possible. A sharp sell-off in U.S. Treasuries has rattled global markets, raising questions about the forces driving this volatility. While inflation expectations and Federal Reserve policy remain key long-term drivers, a more immediate and technical factor may be behind the recent turbulence. The mass unwinding of leveraged hedge fund strategy known as basis trade. The article examines how the mechanics of this trade works, why it has unraveled, and how it contributed to the simultaneous drop in both bonds and equities. The basis trade arbitrage in the Treasury market, which is just another name for greed, corruption, and fraud. In other words, instead of them protecting and hedging assets and investments, they're just making a commission, so much commission, in fact, that they are going to possibly create a new currency. They've ripped us off that bad. The basis trade is a relative value strategy commonly used by hedge funds, especially those operating in fixed income arbitrage. The trade involves buying U.S. Treasury bonds in the cash market while simultaneously selling equivalent Treasury futures contracts. This aim is to profit from the price differential or basis between the two instruments, which I'm going to tell you guys right now, that yield and that profit is very, very, very low. So it takes an overwhelming amount of money just to make a little bit of money. And the problem is you risk everything to get a few pennies on a whole bunch of money. Under normal market conditions, the prices of Treasury futures and the underlying bonds should converge by the time the future contract matures. However, a big however, slight deviations in pricing, often due to differences in funding, liquidity, or delivery options, create opportunities for arbitrage. These pricing inefficiencies are typically small, so the trade relies heavily on leverage to produce meaningful returns. To finance the purchase of cash treasuries, hedge funds tap the repo market, borrowing against the bonds themselves at a relatively low interest rate. This creates a highly leveraged position that is profitable only when the basis remains predictable and stable. Why the trade is unwinding. Over the past several months, volatility in the Treasury markets has increased. This is due in part to persistent inflation, economic data that has surprised on the upside, and uncertainty over the Federal Reserve's rate path. Each new data release has prompted outsized movements in yields, making the pricing relationship between cash treasuries and future contracts more unstable. The rise in volatility has a direct consequences for hedge funds running basis trades. Again, let me read this. The rise in volatility, probably because of liquidity strains, first higher price swings have led to an increase in margin requirements on future positions, thank goodness, forcing funds to either post additional collateral, thank goodness, or reduce exposure, thank goodness. Second, the cost of borrowing in the repo market has increased, squeezing the profitability of trade. In some cases, liquidity in the repo market has deteriorated, making it harder for funds to roll over positions or obtain favorable terms. Faced with rising costs and tighter risk constraints, many hedge funds have begun unwinding their basis trade. This involves selling the cash treasuries they had previously purchased, adding pressure to an already weakening bond market. And I wonder, Mitch, maybe it's not just China and Japan that are increasing residential mortgage rates, or rather the 10-year. Maybe it's the unwind. Maybe I'm wrong. Regardless, the conclusion is this: the sell-off in U.S. Treasuries is not solely the result of shifting macroeconomic fundamentals or Fed policy expectations. It is also a reflection of the internal dynamics of financial markets, particularly the unwinding of large leveraged hedge fund position in the basis trade. This development illustrates the fragility that can emerge when widely adopted strategies depend on stable conditions and cheap financing. As the unwinding continues, volatility may persist across bond and equity markets, particularly if further deleveraging is required. While the basis trade is not new, its systemic importance appears to be growing for investors and policymakers alike. The episode is a reminder that in modern markets, the mechanics of financial intermediation can be as important as the fundamentals in shaping outcomes. The Market Risk Advisory Committee, which is right here, this came out December 2024. I will have this linked. I suggest you guys come here. This is an executive summary, and this is going to point out, there is risk of unwinding this. Let me just read a couple bullet points, okay? The U.S. Treasury market serves as the benchmark risk-free yield curve and a source of safe and liquid assets globally. It is used to finance the government and implement monetary policy and supports the role of the US dollar as the global reserve currency. Its liquidity is therefore key to financial stability. The basis trade has garnered significant attention recently, with elevated Treasury futures actively driving speculation that the strategy has grown amongst leverage fund managers. You can also go to the Board of Governors of the Federal Reserve and see their warning here, as they also mention quantifying Treasury cash futures basis trades. For the viewers, question number 2. As the viewers, do you guys understand what the derivatives market is? Okay, so that's your question 2. Mitch Vexler, my second question to you: in what way can the unwinding of all of this debt potentially usher in a new type of currency, potentially revaluing gold? How can this devastation and atrocity play a role into that?
It's important that everybody understand the document that I did called Thesis and Fact has all the graphics. And there's another document out there. It's called the Fed Quantifying. And it was done in November, but there's a 2024. But there's an interesting line in there. It says visibility into the volume of basis trades has previously been limited. Well, what's going on here, as I did in the Thesis and Fact document, show you the graphics of a giant circle where this money is moving around and how it's moving around. But the point is that the leverage of that money, be it what the Federal Reserve accepts as collateral, even though it's junk collateral, not mark to market, no recourse against the banks. So they accept this paper in exchange for giving US treasuries. Then those banks that gave that collateral may realize that, oh, well, we have junk, so now we're going to go ahead and we're going to start shorting the underlying, let's call it the US treasuries in the futures market. But when they do that, and then they use credit default swaps and swaptions and credit loan obligations, that leverage can be up to 60 to 200 times leverage. So then what happens is long-term capital management. It only takes just one bank to go down, just like long-term capital management, and the whole house of cards to the tune of 600 trillion, give or take, comes tumbling down. It's over. And that goes to Travis's question of what if? Well, these debts that are non-recourse and paper chasing paper derivatives that have nothing to do with the exchange of the futures markets per se. It's the leverage of the paper chasing paper that's the problem. It's the interbank guarantees that's the problem in the Fed's world. That has to go away no matter what. The theory being that if the US national debt plus the unfunded liabilities, let's call it 200 trillion, was to be exchanged for what we had before Nixon got rid of it, the gold exchange, so that you could exchange $1 for an ounce of gold. If we were to go back to that, gold would be priced somewhere between 48 and 80,000 an ounce. It would require a complete repricing of gold so that the US dollar would be backed. However, what nobody is talking about because they don't understand it, which is what we're trying to explain with regard to these derivatives under the hood. If the derivatives were involved, and if the government said we're going to keep these derivatives, which would be just out and out insanity, because it's all junk to begin with, that would push the price of gold absolutely stratospheric, well past 80,000 an ounce. So are these things going to happen? Well, not necessarily. What could happen is that, yes, we should go back to the gold standard or a precious metal standard and or a commodity standard. So gold standard, silver standard, plus oil standard gives you a commodities-based standard from which a US dollar should be based. This idea that fiat currency, given what these morons have done by allowing this hyper leverage at 60 to 200 to 1, is just, it cannot be paid. And it cannot continue because, like I said, one bank can knock the entire thing down. And once it starts, the panic will set in. That becomes the problem. So yeah, I mean, the solution is to back whatever the fiat is with commodities.
I'm getting a little bit of silver just in case. At least I'm putting my money where my mouth is. And speaking of which, putting my money where my mouth is, you guys know that I said, as far as the housing market, that I believe Texas is going to be worse than Florida. Melody Wright thinks Florida is going to be worse than Texas. Let's check in on Florida. This is an article that Mitch sent me last night titled, "More Developers Look to Sell Miami Sites They Once Hoped to Build On." That's not good. Shovel-ready sites are propping up for sale all over Miami as developers that had planned to join the Magic City's building boom look instead to take the money and run from an increasingly uncertain market. Amid rising construction costs, fluctuating interest rates, but they've been 6 and 7 for 3 years, and tariff disputes, developers are increasingly choosing to sell sites that they have spent years entitling rather than sit on land they can't afford to build on yet. Ouch. The hope is to cash out at a premium while the window is still open, brokers said. And I've seen these cap rates. Ain't no one going to buy this stuff. We see it quite frequently where in many cases would-be developers are calling up because they're trying to figure out their best next steps. CBRE Multifamily Sales and Land Development Sales Executive Vice President says they're not in a position to break ground today. North Carolina-based developer listed 2 sites it had purchased in 2022 that were supposed to become 246 apartments. Wynwood 35, a 41,000 square foot development site, was planned first stage of development, has stopped. Evolve expected to finish 141 unit, 8-story project by the end of 2024. But the company listed the tract for $14 million. Ouch. Talk about being bamboozled by yourself. Along its second property in Midtown, which it put up for sale as well for $14 million, just days before the Downtown Realty Advisor agent said something that doesn't matter. Evolve purchased another property, 31,000 square feet, a Midtown lot for $9 million, got approved for an 8-story, 150-unit project that never came to fruition. When push comes to shove, these development sites aren't part of the core business because it's making them lose money, and people aren't in business to lose money. We don't think a hotel project would be appropriate at this time in this area, obviously. In some cases, the developers had intended to break ground a year or 2 ago, and now we're not sure how much longer this choppy environment is going to last. And what that means is they're not going to last much longer. In some cases, they may have lender pressure or partner pressure to go ahead and sell their speculative properties, just like it's going to happen across the United States of America, especially with what, guys? Airbnb, and that's going to be led as far as Airbnb in Texas and in Florida. The trend of entitled properties hitting the market is expected to grow as uncertainty in the development landscape persists, and tariffs tend to hit South Florida particularly hard given the region's constant cycle of construction and active development. Keyword there, guys, is cycle, and cycles don't just go straight up like realtors want them to. The developers that see the opportunity, you mean when they're stampeding for the exits, to sell and make a nice premium rather than taking the risk of developing in this environment. So meaning they're going to lose less money if they sell. And this is crazy. Listen to this. The target percentage for return on cost for developers is you guys, it's 6.5%. I think we can make close to 5% in treasury market right now. And that's just treasury. What if they bought gold? I think gold has went up 20% this year alone. They're going to spend all that time, effort, and risk to make 6.5%. Crazy. Question number 3 for the viewers. Let me know, what state do you think is going to have more turmoil within the housing market as far as prices? Do you agree with Melody Wright? Do you think it's Florida? Or do you agree with me? And do you think it's Texas? That is question number 3. But Mitch Vexler, I have a question for you. Final question, sir, is what's really happening in Florida in regard to these developers? You are one. You have consulting services. You analyze distressed commercial property. Sir, what is happening in Florida?
It's not just Florida. It's happening in Texas. It's happening in California. It's everywhere. It's what I've been saying, which is nobody can get a yield. It's very difficult to get a true economic yield, because if you build in today's world at, let's say, $325,000 per multifamily unit, stick and brick building, 4-story is what you can do it for with parking. Well, that requires, give or take, $3,200 a month in rent. And then, as I've been saying, all that matters is the median household income. And if your median household income can only pay $1,500 or $1,700, you're done. I mean, you're completely upside down. There is no way to get an economic yield. You're bankrupt. So these developers that bought this land thinking, well, or wannabe developers, thinking that they can make money, kind of like house flippers, well, we'll just buy it and we'll flip it. I mean, it's complete nonsense, and anybody who did it, they're wrong, they're stupid, they're going to be found out to be wrong, they're going to have to hand the properties back to the banks, and that's what you're starting to see. So when an article comes out and says, well, they're going to try to cash out their premium in the land, that's code for, yeah, I'm looking for a sucker, and we went to the press to use the press to try and help us find that sucker. And that's really what that means. So again, listening to the press, you have to be able to read between the lines. And some of those sites in Miami, I'm familiar with a handful of them. They are good sites, but land is only worth what you can do with it. And if you can't get it built today, then the question is, how long do you have to sit on it before you can build it? And what's the economic yield while you're sitting there doing nothing? So none of this is good. And those eventual prices will be bought by people who have brain cells. And they will be looking at it and saying, okay, if I buy it today, what's the discounted net present value of what I buy today as compared to where I think it's going to be in the future? And how many years is it going to take me to get there? And it doesn't matter where it is, it's happening.
I just think it's so interesting that during the global financial crisis, the whole economic meltdown was blamed on subprime lending, which was an issue. But as we've seen from the constant reports, especially from the Board of Governors, the main issue, though, with the global financial crisis was commercial real estate. It's interesting that we have something similar going on right now. But I want to end here, you guys. Do not, whatever you do not forget to go here. Any recent videos description, I'm going to do this with you guys. Look at it, says more right here. Click this more and look at all of these links that we have. This is some great stuff. Let me show you what it is. One of the links is this free website. This is free. It doesn't cost you money. It costs you time and gives you value. This is realestatemindset.org. Mitch and I have made courses and downloads, everything for you guys. And don't forget to go to Mitch's website right here, Mockingbird Properties. Sign the petition. He has so much evidence here under DCAT. He also does consulting services. Reach out to Mitch, and definitely do not forget this. This is absolutely free. This is a criminal complaint. If you're sick and tired of all the fraudulent school ISD bond debt, we made a simple criminal complaint along with 6 steps that you guys need to take to file this bad boy. You guys, it took me 10 minutes. I did this on video. And when you're done with that, I want you to go to one of these courses right here, how to do a market analysis or how to end property taxes. The value here, you guys, is overwhelming. And if you guys want to join our Discord community, please join our Discord community. We are building up from the ground up. We don't have a lot of people in there, so you're going to get a whole bunch of attention. This has to do with the housing market, uniform state sales tax, letters to repeal property tax, criminal complaint, protesting your values, using comparables to find value. But either way, we hope you guys found overwhelming value in this video. Don't forget to like it. Don't forget to share it. Don't forget to comment and answer the questions below. And if you guys are out there investing in yourself, the relationships in your life that you love, you guys already know we wish you luck and we hope you win.